If we understand the current function of central banks, we can analyze their actions and thereby determine future events. If they change course, so will the events. We have seen unprecedented levels of monetary easing, ultra-low interest rates, and secret bailouts, all to prevent the global economic collapse. But in the end, the system will fall apart. You came here for the truth, so let me unveil that for you. Today we're going to look at what central banks have been up to and what this means for the future. I've got several charts to show you today and some articles interconnected with that. We are looking at this globally, and I want to begin with this central bank balance sheet assets in the trillions of dollars. You can see that they printed about $20 trillion since, according to this chart here, we're looking at the beginning of the year 2000, essentially, from what I gather. And that had increased dramatically as we saw during the financial crisis timeframe, which obviously is right here. You could see where they've escalated to, and that was a very big issue, not just for the Federal Reserve, but also for the Bank of Japan, People's Bank of China, and the ECB. All of them increased the amount that they hold on their balance sheets, and they did so with the printing press. The elusive printing press, which is there in order to be the lender of last resort, and yet it has been there to buy up basically everything now at this point. It's not there to be the lender of last resort. It's there to buy ETFs, stocks, asset-backed securities, garbage, and more garbage. And that's really what has happened, and to the tune of about $20 trillion. But since the financial crisis, that number has been about $15 trillion, all right, just since the financial crisis. Now that's a big number, but if you compare it to the whole stock market, obviously the whole stock market is much larger, the whole bond market is much larger, and we look at these numbers and have to say, well, it's not that significant, but you have to understand what this means. That's $15 trillion of liquidity injected in a short period of time. That right there was backstopping the losses. At the same time, it provides insurance to the market to say, if they're willing to print 15, maybe they're willing to print 30, maybe they're willing to print 100, and so I feel more confident I will invest. And that's really all it's doing. It's an insurance policy. Of course, this $15 trillion is just the tip of the iceberg, because you know that the Federal Reserve printed $16 trillion on top of the $4.5 trillion during the financial crisis. Who knows what these other central banks have done as well. Now the problem is this. You can see right here, it might be hard to see depending on your screen size, that there has been some deleveraging. The liquidity is drying up. Liquidity drying up is, in fact, the worst possible thing to any stock market, to any financial market, in fact. And you could see that this has been going on for a little while. Throughout this year, in fact, we have seen the slow, especially on the Federal Reserve, slow and steady decline in the amount of money that they are printing. And I think we're going to have a very, very big issue at some point in the near future. The unprecedented expansion of major central bank balance sheets in the wake of the global financial crisis supported a broad range of asset prices as intended. Today, as those banks taper or unwind that stimulus, that's in the chart I showed you, it poses a danger not only to financial markets, but also global growth perspectives. Of course, you print money, it pushes the markets up. You take that printed money away, the markets fall down. Why is it a so-called, a thought in my head? Why is this just an idea? Why isn't this a fact? It's brought up for that reason. It's going to come down for the same reason. It's not as if they've done this, haven't done this before. They have done similar things before, not to this degree. This is the most extreme, but here we are. They talk about the ECB here. The ECB's plans to end its asset purchase program by year end and raise rates in 2019 seem overly ambitious. Obviously, they're not going to be able to do this unless this is the time where they're ready to crash the market. So we'll see. The Bank of Japan effectively conceded that its radical approach to monetary policy had not worked in scuttling internal plans to raise rates twice this year. Whether or not they're going to do that, we'll see. We saw, though, that the Bank of Japan has been, without announcing it, tapering, and that has been quite the surprise to many, because they've been buying up basically everything, and they've been suggesting we'll do anything it takes to maintain this facade. That's the Bank of Japan. silent taper because, of course, they're not making it a policy. They don't want to spook the market, but they have started to print less. They're still printing. Don't get me wrong. They're just printing less. And less money means the stock market will not be able to continue on. They've been buying up basically everything. I mean, 80% of all the ETFs in the country is ridiculous. They're printing up money to buy bonds. They're printing money to buy everything at this point. Central bank assets, G4 plus the Swiss. I've shown you this before. I've shown you the G3. I've shown you the G5 and so on. But you'll look at this. This is the G4 plus the Swiss. Percentage year over year contracting rapidly. And the similar action occurred in 2013 and 15, and where we had the whole taper tantrum. We had everything that occurred in 2015. China did poorly in 2015 as well. But we're looking at this here, just showing us what has been going on now. This has been an issue for quite some time. It's been up and down, but this is globally now. We have to understand the Federal Reserve isn't keeping their assets at the same level. They're starting to slowly but surely bring that down. We'll see if they can continue to do so. And then you have the whole issue of the other central banks engaging in the same policy. All right, global US dollar negative as US monetary base contracts. And this is an issue that I have thought about. If we can see the US dollar itself rising, right? That puts a lot of pressure on other countries because they are pricing everything in US dollar. That's going to put a very, very big, I would say a lot of pressure on their backs of these countries. They're importing and so on. This, by the way, the blue line is just showing you world US dollars. The treasuries owned by the foreigners, the money supply. And I would have to think that a contraction of the money supply is pretty much the biggest danger to the financial system because it's all riding on the fact that more and more and more money is coming into the system. You could see the velocity of money declining considerably over the last little while. And, if we have this change of pattern, we're going to have a very big issue. Global money supply, M2 year over year, deaccelerating over the last 4 months. Now, since the whole VIX issue, we've had turmoil up and down. And as you can see what has happened, it's not the first time this has occurred. So just based on this doesn't necessarily mean anything's going to occur. I just worry about this, the monetary supply. I mean, it is a fraud. We're looking at it, and we have to understand that if they can't progress with it, if they can't continuously add more money in, then we have ourselves a problem. It's a matter of fact. They can change that though. That's what I want to stress. They could simply come out and print, and start up a QE4 and everything is back to normal again. Stocks can rise as far as they want. They can do that. But are they going to? Right now, I want to show you the difference here between the NASDAQ, that's the green line. There was some turmoil. What I want to stress one more time, as I always like to do, because there's the confusion here on the part of many. Look at this. All the market, here's the VIX, okay? VIX index issue happened right here. All markets dropped together. And then we had a decoupling that occurred. And the NASDAQ rose higher and higher because the market's looking for somewhere to put their money, okay? They don't want to leave it in money market. They don't want to leave it in cash. They want to be able to produce a good profit. So they found NASDAQ. They found a certain handful of tech stocks, and that rose to new highs, breaking previous records far beyond that. But look at the red line, which is emerging markets. And emerging markets are one that usually would be able to attain more gains than something like US markets. You would say have slower and steady inclines. However, the emerging markets is supposed to be there to have individuals, hey, I want to make a little bit of extra profit. Let me put my money in here. And that's definitely not the case right now. I mean, emerging markets are in a bear market here at this time. I keep hearing this silly repeated pattern of everything is up. Everything is up. What are you talking about? Anyway, the orange line is the global systemically important banks. Look at this. Look how terrible the performance has been since that point. But look, all throughout 2017, it was doing so well. And now today, you see this. Something certainly going on today. All right. The end of QE and the risk of foreign outflows increase the need for a marginal buyer. What are they going to do here? When they start to have this issue in Italy, this is the Bank of Italy, by the way, Goldman Sachs and the Bank of Italy provide this source. But what I have to understand here is that over the last few years, the only buyer of Italy's debt has been the ECB, the ECB's QE. Now, you have all these companies all across the Eurozone. They are suffering greatly. And the reason why we haven't seen many bankruptcies, the reason why we can still have a system that remains somewhat intact, is that we have the central bank, the ECB, coming out and using their CSPP program to purchase all of these different the debt of all of these different companies. And I've shown you the list before. I've done videos. I've been oddly accused of not showing the data. I've done it more than one time here on this channel. I showed you all the charts that are involved, breaking it all down, showing you the exact companies that are there. I mean, pretty much any company you've heard of is getting a bailout from the ECB today. They didn't get one, 10 years ago. They're getting it still today. It's part of the CSPP program. You can look it up. It's not a secret program, okay? It's a fact. But the ECB has other programs as well. They have a whole list of them I've shown you here before. There's a massive quantity, and it's not just Italy, but Italy is a very big concern because they're holding on to so much garbage debt, and in the event that they go down, I don't even know how the rest of Europe is going to survive. I mean, we've got the problems going on in Spain as well. This right here, by the way, is the national debt in relation to the GDP. Well, we can point to Greece and say that I was told, by the way, everything is better now in Greece by some people. All right, fine. Italy, just behind them, 133%. Portugal, 126%. Look at Spain, almost 100%, and so on. I mean, these countries, there's no way they will ever be able to pay off their debt. And the debt increases as long as they're going to increase interest rates. So the ECB is keeping them low and for a long period of time. This is very important to understand the information out of the Wall Street Journal. I'm just going to read you the first paragraph, but definitely you can read the whole thing. It's quite good. 10 years after the Great Recession's onset, another long, deep downturn may soon roil the U.S. economy. The high level of asset prices today mirrors the earlier trend in house prices that preceded the 2008 crash. Both mispricings reflect long periods of very low interest rates caused by the Fed. Now that interest rates are rising, equity prices will fall, dragging down household wealth, consumer spending, and economic activity. I couldn't agree more. This is very accurate in this case here. I'm not necessarily saying that I'm going to agree with everything this guy says. I'm just saying this here in this paragraph, definitely. I also want to mention the fact that there's a website called outline.com. I would go to it, and if you find a website like the Wall Street Journal is a paywall, you can get around the paywall by typing the link in or pasting the link into outline.com, and it may get around that paywall. If not, though, it sort of gets rid of all the advertisements on here. There's no ads, there's no pop-ups, there's no banners or anything like that. So I really like it to make it nice and clean. That's outline.com. Wanted to bring that to you. I'm going to end the video there. If you found it informative, please give me a thumbs up. When you give me a thumbs up, it helps support the channel. So I do appreciate that very much. It's very simple. All you got to do is click one button and you're supporting me. If you want to comment on the video, just say hello, just say hi, just say ECB, just say Europe, just say Spain, just say Italy, say any word at all. I'll try to reply to you as well, and that's promoting this channel. That's it. That's all you gotta do. I'm not asking for any more. If you want the financial education you were not taught in schools, well, these two books have it all. When you read these two books, you get everything you need to know from A to Z. You will find it all. Link is in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.